Thank you, everybody, for joining us today for our WP90X Exit Planning in Reverse. And you're probably wondering, what the heck is exit planning in reverse? And we'll get to that in a minute. A little housekeeping, restrooms, past the elevators to the right, and then they'll be on your left. For the Denver office, welcome to the webinar. And I think it's out the door to the left and at the end of the hall to the left and right. And for all of you online listening, you know where you need to go. Okay? So I'd like to give a little backdrop and introduce some of the partners in the room that work with us on the business advisory side. We have two sides of our practice, business advisory side and insurance advisory side. We do all of the succession planning and the exit strategies from the business advisory side. And today we have John Chianchio with us and Frank Caputo. And then up in the Denver office, we have Peter Maturko. So there's four of us that work full-time serving clients on succession planning. So 9 years ago, yesterday, WealthPoint was formed. And we have an intentional practice on exit planning. We don't just do exit planning and succession planning sometimes. We do it every day. So we're really not practicing on clients. We have a body of work over the last 9 years where we served well over 80 family groups on the difficult subject and topic of how are we going to have this business successfully succeed us sometime in the future. And one of the things that we did was we looked at our book of business last year to find out what were some core characteristics of every client and families and stakeholders we've served, and there was a few things. The biggest thing that everybody came through the door with was they wanted to improve outcomes, right? And so when they engaged us, not only did they want to improve outcomes, they expected us to help them improve outcomes, right? But then there was three underlying things that everyone was concerned about when they walked through the door. And really, the first one is complexity. As our clients became more and more successful in their business, their personal side, they created more and more wealth for themselves. Do you guys in the room think that made their life easier or more complex? More complex, right? So they wanted help with that complexity, and we helped them navigate all of that complexity. The second thing they came through the door with was uncertainty. So many of our clients say, I know I'm on the right path. I've created a successful business. My financial net worth is up, but 85+% of my net worth is wrapped up in this operating business. So the uncertainty piece was, if I keep doing what I'm doing, and everything that I've implemented to date on my personal planning side, is everything going to be okay? Am I going to be okay? And that uncertainty increased as the timeline compressed or the runway shortened for when they needed to step away from the business. Does that make sense? So then the third thing that they all came through the door with was lack of collaboration. And one of the things we're going to talk about today and hit on is the importance of a multidisciplinary team as it relates to a successful succession plan in the business and then the eventual exit. So collaboration, meaning every successful business owner that owns that business in their family group, they have a CPA firm they work with. They have an estate and corporate lawyer that they work with, right? They have wealth management firms that they work with. They have consultants all flavors that they work with. They have commercial bankers that they work with. And we put all of these people into the mix, yet we are never taught as entrepreneurs how to successfully navigate those relationships over time, right? We have all these entrepreneurial classes in colleges now to teach kids how to become entrepreneurs, right? So they have this thought in their head, they'll get out, start up a company, and they'll be billionaires overnight. My experience in my former business life through a 20-year run was I did a terrible job of leveraging the skill set of my trusted advisor group. I paid fees all along the way, And we were an $85 million business when we sold to Fuji in 2003. So the amount of fees that we paid for employee benefits people, for risk management, for CPA work, for legal work, consultants that we brought in over time was a significant number. There is not a class that I know of that teaches people how to leverage their trusted advisor in a collaborative process, right? So when our clients come through the room, through the door, they have all these people. So we ask the question, if we lined all those advisors up in our conference room and asked them, what are your top 5 goals and the timeline associated with it, would we get the same answer? The answer is absolutely not. So we work really hard to create this collaborative process that leverages everybody's skill set on behalf of the owner once we put the stake in the ground of what do they truly want. So when we talk about exit planning in reverse, the reason they avoid the topic of succession planning and exit planning is because they don't know what it should look like. They can't answer the question, what am I going to do 5 years from now? And when a professional asks them, what are you thinking about doing with this business? The response they'll get or give depends upon the day, right? When they say, I don't really know, I need to figure it out, depending upon who they're answering that question to, the race is on. And many paths at that point in time lead to a liquidity event, which becomes self-serving to whatever professional says. The only path for you is to sell this business, because many businesses shouldn't sell. They could be owner-investor because of the repeatable, consistent cash flow that they'll get from that, or they should transfer to the next generation, right? So we look at everything from the beginning, and we do things in reverse. What do you really want? Make sense? So let's get started on what that really means and how we do that. So we want to accomplish a few things today. We want to identify the why, how, and what of succession and exit planning for you. We want to define the unique process for business owners to make key decisions. So if there's any exit planners in the room, I want you to look at this from a learning process, because I've been involved with every group that's out there, from BEI up in Denver, which created a process, from Pinnacle Group out of Boston, John Leonetti, which created a process, Navix out of Atlanta, which created a process, and EPI, or Exit Planning Institute, with Scott and Chris Snyder, that also created a process, right? We have 3 CEPA-certified advisors in our group, but we don't follow that process. We created our own 9 years ago. But we felt that that accreditation from how do you work with business owners from the business perspective to maximize value before transfer, if it is a third-party sale, but every one of those firms or associations look at it as exit planning. We don't. We approach everything from a succession planning perspective. Understand the definition of key stakeholders and their role in the process and how they may stall forward progress or momentum because they weren't involved in the initial process. So they could be a big speed bump or a barrier to achieve what the current decision makers want to achieve because they weren't included in how they felt about things. Determine how to stress test decisions across 3 realms. So numerical, operational, and relational, which really is a decision-making process instead of a planning process. So why exit planning? These numbers are staggering, the amount of trillions of dollars of wealth that will transfer over the next 10 to 15 years, right? So if we look at the 15 trillion in privately held wealth, the lower middle market of 5 million to 100 million revenue companies, about 5.8 trillion in sales, creates 2.9 trillion in market value. So something's going to happen to these companies. Somebody needs to help them navigate these things. So I think there's enough for all the professionals in this room to do some great things for these clients that are facing these issues, right? Baby boomers represent 67% of that number. I'm one of those, right? When we sold our business, there was no intent to sell at the time we sold. So it was one of those unsolicited offers. And we all get those as business owners over the lifetime of running and owning a business. This one was real because there was a financial buyer that had the money to buy because it was Fujifilm, right? The Exit Planning Institute reported that 76% of business owners want to transition out of their business. In reality, only 20 to 30% of the businesses that go on the market actually sell successfully. That's staggering. Why? Why only 30%? So I won't go into the next piece, but the Family Firm Institute evaluated the success rate of multi-generational family businesses. 30% move on to second generation, so 70% don't. 12% move on to third generation, which is a really, really low number. And we have, in our client base, we have several second, third, and fourth generation families that we currently work with. And then going on to fourth generation, less than 3% or 3% go beyond fourth generation. And many of us think the reason they don't go from first to second, second to third, is because of family dysfunction, right? Merle could speak to that. But it's really not the main reason. The main reason they don't transfer is because there was no plan inside the business that said, if we go from first to second, second to third, and the family group grows to X, is the business big enough, and does it throw off enough cash flow to support all these other generations? And the answer is typically no, that it didn't. So that forces the sale of the business because there's just not enough to go around. Does that make sense? To everybody but no. Yes, we will. Russ, we will. But I like to see you be so diligent taking those notes. So family and business goals are our area of focus at WealthPoint. So we really need to understand what are their goals first. Every family group we work with, every business owner we work with, many of the business owners you work with face all of these issues throughout the lifetime of their business as well as their personal financial life. In the typical planning process that they're offered today, we could take one of those issues, which let's say they need to update their operating agreement. So we identify that problem. We want to isolate the objectives associated with that, engage the proper service professional, and that person typically can only provide silo-specific recommendations. So as it relates to the operating agreement, I'm going to hire my corporate attorney to look at that operating agreement and say, could you please update this? A couple things have changed. That person wants to do really good work and starts asking me a ton of questions. And I'm sitting there as the business owner looking at the clock because I'm utilitarian and fee sensitive at the same time. And I'm going, wow, I know you're $600 an hour. How deep do you want to go? Because I don't want to go there. I just want you to update the things that I just communicated to you, and then you get the document back to me, right? Which then leads that professional that can do really good work into a limited situation around what's going to happen 5 years from now, 10 years from now, 15 years from now. And there's all kinds of ticking time bombs because of the partial presumptions that need to be made to fill in all these blanks on the information we don't receive from the entrepreneur. Has anybody in this room experienced that by the show of hands? Right? So we think that's a broken model because every client that comes into us has things that they put in place that once we get to the bottom of where they really want to end up and get some clarity around that, we need to fix things, which then generates a lot of work for all the other professionals, not from a sales perspective, but from doing the right thing and fixing things that are currently broken or not aligned to where we're eventually going to end up. So many of our clients come through the door and they haven't implemented on things because they push back from the planning table, right? And that is a decision that too complex, don't get it, instinctually not understanding what the upside and the downside of the decision you're asking me to make. So I'm not going to make a decision today, and I'm just going to push away, and I'll get around to that later. Right? So we have a client that coined a phrase for us about 7 years ago. His name is Javier Varela. He's the CEO of a foundry down in Cananea, Mexico. He's third generation. When we met, he was second generation. There's a advisor relationship we have that introduced us into this client. And they were pushing back because he didn't understand all the unintended consequences from all the complexity that was involved in cross-border planning, tax planning for Mexico, for the U.S. How do you get it from second generation to third? How do you move from third, and how does that impact fourth? Right? So I'll do nothing. So they came into our office, and Javier said, that's what I've been telling my family group. We need to look at everything in its entirety so we understand the impact of these long-lasting decisions people are asking us to make. So we start every engagement in that middle circle on our Venn diagram, know your story, and that's truly giving the time and the respect to the families that own these businesses. First, the current decision maker, what do you really want? What do you really want? Right? And when we get clear on that, we take it a step further and we invite the stakeholder group into the process to find out what do they really want. And the clients we work with, one of our first filters is, do you care about others? And if they don't care about others, they won't be a client of ours, right? Because we need to get into that stakeholder group defined as active or inactive kids, other family members that aren't associated with business, but they might be second generation cousins consortium. They're getting distributions from the operating asset. And then key people in the business, which are the people that are running the day-to-day operations, right? We want to invite them into this process as well so we can understand what they're thinking. The other people we want to invite in are the trusted advisor group. We want to know how they've impacted the family group, what their thoughts are, what they've tried to put in place that the family group pushed back on, so we can all align to those goals. By going through that know your story process, it really creates that clarity for the current decision makers to move into a place that we call still wisdom. And that still wisdom is that place of instinctual knowing that this is what I really want sometime in the future, which then helps all of us as professionals not make partial presumptions around where we think that business is going to end up. Then we move over to the instinct verification side, which is a proprietary financial modeling tool we used or built because we couldn't find one out in the marketplace, because we would have really preferred to buy some software that was already out there instead of building this proprietary numerical process, and we couldn't. But that helps our clients understand numerically the upside and the downside of any decisions we're asking them to make as a professional group. And then the pulse of progress is really project management. We haven't had a client to date that says, I got a really great plan, my attorney's aligned, my wealth managers are aligned, all the other trusted professionals are aligned, my tax person, my audit person, consultants, wealth, the whole list, right? I'll take it from here. They're busy running the business. So we help them execute on everything that needs to be completed to achieve true succession in the operating asset. How do we do that? We want to help our clients find their why. Getting to be kind of a worn-out phrase, right? The why, what's your why? But it really works when we find collectively what this group of individuals wants to achieve. Excuse me. Need a little bit more coffee, rev me up. Seemed too quiet, right? So you have the stakeholder group, the exit planner, which becomes the quarterback to help establish some global macro goals. And just keep in mind, these global macro goals are the piece that gets into their heart. Because you're not going to get the shelf space until we have some emotional anchors that are really important to this decision maker to achieve somewhere in the future. So if we can't find those, we don't move forward with a longer term engagement because we'll fail. We have to have those emotional anchors that get them in their heart before we can get them in their minds, right? We do that by going through an initial interview process with all the stakeholders. These are the likely people that I mentioned just a minute ago. Founders and spouses, partners and spouses, key employees. A key employee definition for us is if they weren't there yesterday, it would seriously impact the future success of the business. That's not typically what we get walking through the door. Many times there's C players that have been there a long time, and there's a dependency upon them because they're familiar. They're not really moving the business to where the business needs to go. So it's good for us to know because we're going to have to fix that sometime in the future. We help that business owner identify it. Because many times there's just this familiarity and comfort of doing it the way we've always done it. And so we uncover it through this process, right? And then key advisors, I named the key advisor group, always initially in the meetings or the interview process. And then active and inactive children, age appropriate. And for us, age appropriate is senior in high school and above. And there's some amazing things we discover by interviewing the kids. The business has either impacted them in a positive way or a negative way. There's not a lot of in between, right? But that helps us understand what they're feeling. And it also helps us understand, because in a large percentage of our clients come through the door with this thought that it should be second, third, fourth generation business, because that's what they want to have happen. The reality of that changes later, right? But we want to find out, is there any fire in the belly? Is there any emotional attachment from second or third generation kids that they really want to be in this business? Many times in some of the work that we do, we find second and third generation that has been gifted the asset and they hate the business, but they're trapped. Because what they're getting paid for the role that they're providing inside the business is way too big for them to find something outside the business. Plus their current lifestyle requires that level of income, and now they're trapped in the business for 20 years or more. It's kind of sad. So we want to fix those things, right? And we're able to do that through this process. So when you look at this body of work, what we really want to find from these interviews is those emotional anchors that will help change behavior to achieve what they say is important. Would everybody in this room agree by a show of hands that the behavior change in business is kind of difficult? Right? So those emotional anchors have to be real, or we're going to get stalled throughout the whole process. And many of us have worked with business owners, affluent families, so on and so forth, and many things stall. We've created this process to prevent that from happening. So now we take all those issues that were present and we bring them through a funnel and we create a document with detailed goals, objectives, fears, and findings, and we'll show you an example of that in a few minutes. We also talked about those global macro goals that need to be those emotional anchors where we can drive behavioral change to achieve what everybody says is important to them. So now we share this, we change the traditional planning process where it's siloed into a multidisciplinary process by sharing all of this with the multidisciplinary team. So for the first time in the decision maker's life, they're seeing all their documented long-range goals in one place. We create financial models around the documented long-range goals, but then we share that body of knowledge with all the other professionals. So now the professionals can do their best work and be in an environment where it's no longer an expense, it's an investment in everyone to achieve this goal for the business owner and the stakeholder group, which changes the whole trusted advisor dynamic, because a lot of us fight fee sensitivity every day with clients. I really need that, but I'm not willing to pay that for that, right? And business owners, we're a pretty frugal group, especially the really successful ones. They look for that value. What am I receiving for the check that I'm cutting on a regular basis? I envy the wealth management industry because they don't have to send an invoice, right? I mean, that is the best business model on the planet. We have to send an invoice on a monthly basis, and I'll also share how we do that. So now we get to share that body of knowledge with the stakeholder group, and so they can do their best work. But all the solutions are then held accountable to the global macro goals, and we want to be doing that in the background, not in an environment where the decision maker is in the room, right? But if they're not germane, we move on. Many of our clients say, oh, I've been in a collaborative process before. I went into the conference room, everybody was whiteboarding stuff, but what I noticed was they're asking me to make decisions in that room, and they weren't even aligned themselves to those decisions. They were spitballing. Throw it at the whiteboard, see if it sticks, right? Didn't enjoy that process. So if they are germane, we want to stress test them. We want to stress test them on 3 levels. We want to look at things numerically, operationally, and relationally. So first, numerically, we build financial models in that instinct verification phase. We'll show you an example of that. But when we do this, we look at things from where are you really today? So let's set a credible baseline and get rid of all the myths that are walking around in your head. I'll give you an example of a myth. I was in the same business for 19 years. We would go to the National Trade Show in Chicago, Graph Expo, every other year, and we would listen that, hey, Sue sold her business. She had a distribution company just like I did, right? And then your group of friends would go, sold it for $45 million. So everybody in that group goes, well, if Sue got $45 million, I'm going to get 60. So that's my new number in my head that I'm walking around with that has no basis of fact whatsoever. But that's really how we work in many cases as an entrepreneur. It's these stories, these myths that walk around with us based around zero fact. So we want to numerically get them, really understanding where they are today. And then operationally, we can make numbers do anything we want, but what is the gap between where you are and where you need to be? And then how are we going to fill that gap operationally? They say, oh yeah, I want to grow. Well, you haven't grown in the last 5 years. What makes you think that we're going to be able to grow by 10% for the next 10? It's a tall order. So we look at things operationally because of our business owner background. We ran companies and successfully exited them. To what does the operations need to look like to achieve these goals over time? And then relationally, if any of us in the collaborative team come back with a solution that blows up one of their best relationships, do you think they're going to embrace that solution? So we know going in how to navigate those things And many, many, many family businesses are about managing drama. So if we need to create a workaround, let's understand what that workaround is, and then let's share with the decision maker what a possible solution is to still keep that person's self-worth, right, as we go through the process, which is key. We do it all the time. No, but we know where to go. But you know, I've been doing this quite some time. I'm good enough now to know when I'm over my skis, and then we bring in other professional partners. Merle Reapy in the room would be one of those. PhD in psychology, right? Dealt with many family members and helps navigate or breaks down those barriers to where we need to get through this to get here. And helping well over 80 family groups, we have met very formidable people that can help us achieve what that family group says they want to achieve in the most professional manner without blowing up families. Many times we walk into situations where there's no harmony left. And we're invited in because the harmony's left the building. And one of the things that's cool for us is we help change lives to restore harmony. And that is, there's no better feeling. So changing that siloed effect to planning, we align the service professionals to those macro goals. We vet the solutions, tax, legal strategy, or structure. And then we help the clients implement with confidence. So how do we work? We've developed a 6-step process. There's many processes in any of the exit planning associations. They're all good. You need to have a process that you stay on track to help these clients with navigating succession and or exit of their largest asset, right? So if you don't have a process, find one, embrace one, because what I've learned, I'm kind of a person that likes to help, but then I see the solution, and I should have learned from 26 years of marriage that she doesn't want the solution. She just wants me to listen, and everything will take care of itself. But I have jumped from 1 to 3 to 4 to 5 too soon and failed. Because when you're dealing with human beings and multiple human beings to get them aligned, it takes time. It takes a well choreographed process, and it takes confirmation from each individual in the process that they get it. They're at a place where they all get it, so then you can move forward. If you jump too quickly, they'll push back from the table, and it's near impossible to get them back. So this is a case study. We've sanitized the case study for confidentiality purposes, and it's around a firm called Arizona Manufacturing. This was the fact pattern of Arizona Manufacturing. So we have Jim, the founder, age 83. His bride had passed away previous to us knowing them. You have Michelle and Rich. Rich is the middle brother, or the younger brother, because there's only 2 sons. And he was picked to be the CEO by Dad, right? Dave, the oldest brother, head of manufacturing, married to Beth, he was not picked to be the CEO of the company, and that created some dynamics with Dave, right? Dave wasn't happy that he wasn't picked, and we weren't involved with them. Dave wasn't picked 10 years previous to us meeting, but it was palpable that Dave was not happy, and the chip was about a mile high on his shoulder, and so it wasn't really a good thing going on inside the business. And then we have the youngest daughter, Jane, and her husband, Matt, who's a son-in-law running the largest, most profitable division in the manufacturing business. And he's not the right bloodline, so he's really not being treated all that hot. So these are just some of the emotional dynamics. Then you have Greg and Sarah. Sarah's the oldest sister, and she's running the financials in the business. She has a CPA certificate, and she's running the family financials. It's a manufacturing company, $20 million in annual revenue and $5 million in net profit. Nice company, right? So we get introduced by an estate planning attorney that happened to meet Sarah at a networking event. They hit it off. They met for coffee. And Sarah started sharing some of the family dynamics that were going on in the business. And Cheryl, the estate planning attorney, said, have you ever met WealthPoint? Everything you just described, WealthPoint could help you with. She said, no, have not, would like to. So I go to the meeting with Cheryl. These people were all in the room, in their conference room. The first thing out of the youngest daughter's mouth was, who do you know, Tim, in the family group? I said, I'm meeting you all for the first time. There was a resounding good from the rest of the family members. Red flag, right? There might be some family dynamics going on. There was, right? So all of the family members were making $600,000 to $1 million in distributions per year. And when I say distributions, that's not fair, because when we met them, they were in a C Corp environment. So it was somewhat a disguised dividends with nice bonuses every year, right? And that was creating some governance issues long term. So we meet with them. We go through the first phase of our process, knowledge baseline. And this is a still wisdom summary, which has been combined with all the family members for the purposes of this demonstration of what's important in exit strategies or succession planning. The one driving force was Sarah. Sarah became the tipping point because she wanted out, right? And I'll get to that in a second. So we help them understand what they're currently spending, where they currently are, each family group separately. This is your personal financial balance sheet. This is the business that's throwing off the cash flow for you to achieve what you want to achieve sometime in the future, okay? So we put that stake in the ground so we can start building the plan backwards. This page becomes really important for the tipping points and how we had to navigate things for the family as it related to succession and exit at the same time. We'll get back to that in a second. The other thing that we do is we go really deep into the operating asset to help them understand where they are or aren't in reality inside that operating asset that throws off all of the cash for everybody that's a stakeholder to achieve what they want in life, right? Pretty important asset. So we also educate them on different methods of exit before they're ever going to happen on what does it mean, net, pennies in the pocket. But I just want to show everybody how deep we go into that operating asset because of our understanding of starting, growing, and actually exiting businesses. It's a different dynamic and voice that gets brought to the table as it relates to us in the mix when it comes to succession planning. And I think it takes that group of people and professionals to be able to successfully navigate a succession plan because we had every other advisor involved in this process over time. So as you can see, I'm not going to go through each one of them, but there's these key things in succession. There's management succession, there's ownership succession, relationship succession, culture succession, right? As it relates to true succession planning inside an operating asset. Many of the businesses that we work with, the owner says, I'm going to transfer this to the key people. They've helped me become successful. They want a shot at being owners. And oftentimes we have to say, so here's you in the mirror, and here's your key people in the mirror. They're going to leave when you leave. They're just as old as you are, right? So now what? We have to back that up with who's up next. Who comes in, who's ready, who's not, how do we get them ready to really, truly succeed in running this business and protecting the continuity of the business. And then we look at the estate planning currently, and is it aligned to where they want to end up? And typically it's not. In this case, the estate planning, in many cases, there's multiple partners in a business. They can be related, non-related, but the triggering agreement in the operating agreement says, if you were to pass away prematurely, your spouse is not going to be a partner of mine, and so we're going to buy you out, and this is the formula we're going to use and the way we pay that off. Okay, so what if they want their kids to be able to get into this business? So are they going to get bought out, and then that single owner or the majority owner is going to say, well, your kids can buy back in? Is that efficient? No, but most estate plans don't have any contemplation on what should happen. And we fix that more times than not when they say we would like our kids to eventually be in the business. So let's go, and then we look at asset protection as well as philanthropic goals at a very deep level. But let's go back to the page that became the tipping point. Whoops, too far. So you have Sarah, the oldest daughter, that wants out. She's identified a likely successor, CFO, controller of the business, and then the biggest point was resolve the keep or sell issue. So Sarah had to work out in her mind and asked us to help with this. So, and I'm just going to non-filter it. If I step away from the financial role in this business, can I trust my siblings to give me my fair share of the profits every year? The answer was, I can't. So I need a solution for that. They need to buy my shares out if I'm going to leave, and I'm going to leave. And I want to leave within 12 to 24 months. Rich and Michelle would like to have the option of maintaining their ownership and give it to their sons sometime in the future. They would also want clarity if they were to buy this asset away from Sarah. What does that mean for them? So it's a second-generation business, right? Remember that. No skin in the game, inherited. No debt on the business. Then Matt would like to continue with Arizona Manufacturing for the next 10 years. He's the son-in-law, running the largest, most profitable piece of the business, provided that the work environment is stable and succession and exit issues have been addressed, which was a really professional way to say, I'm tired of this. Tired of the family squabbles, I'm tired of the infighting, I'm tired of the lack of respect, that my ideas don't matter, so on and so forth, right? They also have 2 kids. They would like to have the opportunity to be third-generation owners of this family business. Dave would like to continue the day-to-day operations for the next 5 years. Dave's older son was passed up. How high was the chip? About a mile, right? He would also like to see succession at all levels, ownership and senior management. But he wants to get the issue sorted out to eliminate the current family squabbles. Dave really lacked self-awareness. Dave was creating 95% of the family squabbles. So we had to deal with that in the mix. And this is not really strange or not present in almost every engagement we work on. There's just different levels of harmony or lack of transparency that we need to get to so everybody understands truly what's happening. And then nobody wanted to kill the golden goose because of the income they were receiving from that asset on a yearly basis. So Sarah became the tipping point. And we're going to go into how we used our financial modeling tool. And Michael Kenneth, our Director of Solutions, will share with you how we helped the son-in-law get his mind wrapped around debt and what the future would look like and what it would mean to them. But it ended up, because Sarah was the tipping point, and Sarah and older brother were aligned in one camp throughout the lifetime of running this business, and really throughout their lifetime of growing up at the supper table. And then the younger brother and the younger sister were aligned, and there was 2 camps. And these 2 camps never changed when they went into business together, so it was the same thing growing up. I got your back, I got your back. It's us against them. We're the oldest, they're the youngest, they don't know anything, right? And we felt that, and it was present, that there was really 2 camps in the family group when it came to decision making. So Sarah no longer wants to be in the business, and so older brother did not have anybody to align with. And older brother was wondering why younger sister, younger brother didn't want him in the future partnership when Sarah was going to be bought out. And so we had to help him wrap his mind around, why do I got to go just because she's going? Pretty difficult, right? We successfully did that and had a sibling buyout of the 2 older siblings, got bought out of the business, the 2 younger siblings then became the owners of the business and still own the business today. One of the hurdles we had, and there was many, but one of the hurdles we want to show you is the son-in-law is running the largest, most profitable piece of the business, yet he's the most conservative person on the planet that we've ever met to date. And we met them in 2012. And when we can stack up all of our clients, none of them are more conservative than this person. So put yourself in this mind frame where they're at. Second generation didn't buy the business, it's gifted. It's throwing off $600,000 to $1 million per family group per year and has consistently done that for the last 7 years. Why would I take on debt? Why would I sign personal guarantees, WellPoint? What are you asking me to do? I need to wrap my mind around the risk associated with this because I have a low risk tolerance. So we used the instinct verification tool to help him get really present on what the future opportunities were and the upside and the downside of the decisions we were asking him to make. Okay, everybody got the scenario? Would you call that instinct verification? Yes, which is the financial modeling tool. I told you I was going to share how we celebrate success on a 30-day basis, and I'll just give you a little insight on that. When we started working on the model for what we were going to do for entrepreneurial clients, I looked back on my career as being the operator owner of a business and said, when didn't I feel good about things? And it's when I couldn't really understand the value I was getting for the check I was writing. And that could have been to a professional services firm, such as at a law firm. It could be an accounting firm. Could have been my bankers. Could have been a consultant. But what I see as a flaw, and I think it's being looked at by many, many firms, is we decided we're going to do value pricing. We're not hourly people. We're results-oriented. Pay us when we reach the result, and pay us along the way to achieve that result. And we celebrate success on a 30-day cycle and do project management with the clients by showing them on the left-hand side, those are all the things we've achieved since we've met each other, getting this on a 30-day cycle. In the middle is everything we're currently working on. They get it every 30 days. Everything on the right-hand side, what's coming next. Entrepreneurs love this. We send it with our invoice, and we don't have a receivable problem and haven't had one for 9 years. And I think it really instills in them the confidence that stuff is getting done, right? It's just something you might think about in your own practice of when you send them an invoice, what kind of value judgment are they making on that invoice you're sending? Okay, go ahead, Michael.
Yeah, so what I'm going to go through is basically how we use that instinct verification in order to stress test things numerically. Tim talked a lot over the past 40 minutes or so about somewhat soft skills, right, and the emotional component and how to deal with what you really want and finding your why. But I think in order to have a successful succession and exit of your business, that has to complement the numerical side of things as well. Can the company afford to do that? Are the right people on the bus? What is the, is a buyout the right strategy? What are the different planning strategies that they should consider? And I think one of the reasons why entrepreneurs back away from those is because they're not sure what are those unintended consequences of doing something like that. If I were to gift my business to a trust, if I were to go through an ESOP strategy, if I were going to take on debt for growth purposes, what does that really mean for me today? But what does it mean 3, 5, 10, 15 years from now as well? And so what we did is basically created a proprietary financial modeling tool that I'm going to show you guys as a way to help our clients make some of those strategic decisions and planning decisions that they're going to be faced with. Before I go through the summary page, I want to give you some background on some of the numbers and analysis that we really do and look at as part of our engagement. Down here at the bottom, you'll see P1, P2, and P3. So that's generally like his, hers, and ours. So if our clients have separate assets, prenuptial agreements, those types of things, we can split everything up. Or if everything is joint and community property, we can put it all in one tab for them. On these tabs, we'll basically look at a personal cash flow statement. So we'll look at all of their cash flows from the various businesses that they're a part of, dividends, distributions, salaries, sale proceeds, loans to and from the business, as well as all personal or passive cash flows, retirement plan contributions and withdrawals, income from their portfolio or their brokerage account, life insurance premiums, rental income, property expenses, anything that's somewhat passive for them that doesn't really relate to that main operating business. We'll also run everything through a mock 1040, so we'll take into account all federal and state income taxes, capital gains, the recent tax reform legislation, so that we're coming up with a fairly accurate tax liability amount for them. They want to really know what exactly they're paying because cash is very important. They don't want to just say, well, that's going to be 45% income tax or something like that. For some of our clients, a change in their tax rate from the 39.6 to the 37 could be hundreds of thousands of dollars or something like that. So we want to really keep that in mind. We'll also then look at their personal balance sheet, broken out into major asset categories like their operating business, loans, personal investments, retirement plans, properties, just so we can see what's the fair market value. All these values are in thousands of all these different asset classes. As Tim touched on a little bit in this case study, this is actually Matt and Jane's personal financial planning model. So we can see that Matt, who was the active member of that marriage in the operating business, he doesn't actually own any of the business. And when he was being faced with that decision of having to go through this sibling buyout, he was really feeling like it was all on his shoulders because he was the only one that was active in the business. The other two siblings that bought them out were Rich and Michelle. Unfortunately, Rich actually had a health incident during our engagement. He actually ended up passing away of stomach cancer. So Michelle is the widow, never active in the business. And then Jane was also owned the shares, but was never active either. You always were able to find her at the golf course somewhere. And so when they were looking at buying out the older brother and the older sister, Matt was really feeling like it was him that was buying them out because he was the one that was really going to be signing up to carry the business from where it was today to where it needed to get to in order to fund that future buyout. We'll also then look at everything from a legacy or an estate planning perspective. So if our clients do have any sort of irrevocable trusts, or if any of the advisors that we're working with these clients are recommending any sort of estate planning strategies, wealth transfer, gifting, those types of things, we can put those different trust entities on here and then really be able to track the paper trail that's associated with those. What we found is sometimes clients don't fully grasp some of those wealth transfer strategies. When you do gift your business, you don't own it anymore, so you have to make sure you follow the proper compliance and cash flows and those types of things. And so we can show them those different trust entities, and then it can really be as simple or as complex as it needs to be. For example, this is just a qualified personal residence trust or a CUPERT. They gifted their piece of real estate to this trust. There's no cash flows until the end of the term. But again, we can see the value of that asset that has been transferred to the trust on the balance sheet. Or it can be something that's a little bit more complex. This client actually did some gifting in 2012 when there was concern that the exemption was going to drop back to $1 million. And they did some gifting where they were able to actually gift some investment accounts to this trust, some real estate or some income-producing property as well. They purchased some life insurance, and then again, we can see the value of those different assets on here. An interesting thing actually with this trust is this actually was more so done for both estate planning and a good wealth transfer planning strategy, but also for Matt's peace of mind. Matt was, again, running the business but didn't own any of it. So what we ended up doing is almost equalizing the estate, if you will, where Jane gifted some of their community assets to this trust for the benefit of Matt. So it kind of, from Matt's perspective, it really evened out the scale a little bit, which I think you can imagine the difficult conversations that happen with that of, I trust you, but I also want to make sure that I'm compensated for what I'm worth. So those were some interesting times that we had in our conference room. We'll also look at everything from a charitable or philanthropic perspective. As Tim mentioned, if our clients have any sort of charitable trusts, donor advised funds, family foundations, we can just show those, as well as if they're making any future gifts to those, just so that we can show, the income tax deduction today, but what does it mean for the charity 5, 10, 15, 20 years down the line. I'll skip over the business tabs just for a second. We'll also look at their real estate investments or their properties, so we can list all of their different properties that they own. Primary residence, vacation homes, rental properties, airplane hangars in the case for this client, land investments, whatever the situation may be. And the important thing here is just that we can show any sort of what-if scenario that we want to with those properties. So we can look at upsizing or downsizing. Lots of times clients will say, well, if I monetize the business and the kids are out of college, I'll sell my home, or I want to go buy a vacation home somewhere or a condo somewhere. And so we can show those different scenarios just to see how are they going to play out from their financial perspective. We'll also then look at their life insurance and annuity contracts, if they have any annuities. And it's just basically a high-level summary of all of their different policies, what are the premiums that are associated with that, and who's paying for those policies. The death benefit, the income stream or the annuity payment stream if it's an annuity contract, and then the cash surrender value. This way we just have a high-level summary of all of their coverage, who owns it, who pays for it, and how much coverage does it provide. And really, we'll get into it in a little bit, but really to see, are we matching up the asset of the insurance policy with the liability that we're protecting against, whether it's debt, estate taxes, spouse security, key man risk, whatever the situation may be. And then as Tim mentioned a little bit earlier, we really dive into the operating business. If you look at most personal financial planning software, it really doesn't deal with the operating business. It's more so designed for either highly paid executives or individuals, family groups that have a bucket of liquid assets. And we're talking about managing risk and stock and bonds and tax harvesting and those types of things. But for all of our clients, I'd say on average it's probably 85% and up of their net worth is tied up in that illiquid operating business. And so we really needed to create a tool that we could use to help our clients make decisions. In order to do that, we had to show them the ripple effect of decisions that they make in the business. How does it flow back to them personally, or to their trust, or to their kids, or whatever the situation is, and how does it affect all of those areas of focus that they have, from spouse security, estate liquidity, business succession, all of those different things. And so how we'll do that, we actually gather up quite a bit of documentation as a part of our initial process. We basically will ask for the last 3 or 4 years of financial statements, tax returns, work with the advisors on their team in order to gather all of that information. Most of our clients don't exactly have all of this information handy, but their advisors do. And so we'll basically use those to populate our model, develop a credible baseline, and then in any of these teal-colored cells, we can change around the assumptions on a go-forward basis. So we can add in new revenue streams, new product lines, new branch locations. We can show growth rates. We can also start and stop years, so nothing is linear in our modeling. We know that the company's going to grow at 12% and then lose 3 and then grow by 6. It's not going to grow at 8% a year forever, regardless of what some of our clients will tell us when they're talking about their business. And so what we want to be able to show is that up and down cycle that's normal with all businesses, so we can really get realistic with some of these projections and the assumptions that we're making. We'll do the same thing on the expense side, so we can add in all of their expenses, factor in any increases, or if they're going through a cost-cutting phase, show those decreases. That way we're able to track EBITDA for the company as well as net income or profitability, and really start to see how much cash flow is this operating business actually generating on an annual basis. We'll have a few different sections as well to look at. I'll go through a couple of them. This one here just looks at SERPs, or supplemental executive retirement plans, basically all different types of executive benefits, deferred comp plans, phantom stock, those types of things, just so we can put those plans in here so we can see what the financial statements are going to look like whenever those plans become due and those obligations have to be paid out. It's real important to stress test those, both from a company perspective, can we afford to do that strategy that's being recommended, but also from a participant perspective. You know, my company says they want to provide me this benefit, but I would like to see some information to show that they actually can provide that benefit when I'm 65 or 70 or whenever the situation is where they have to pay out those payments. We'll also have a section where we can look at taxes, so we can make any adjustments that we need to account for the differences between book and tax financials. Again, so we can just factor in and come up with a fairly accurate tax liability amount for them on an annual basis. So if there's accelerated depreciation, the 199A deduction from the tax reform, inventory write-ups or decreases, obsolete inventory, those types of things, just so we can show those from a tax perspective as well. The next section is probably the most important one that we look at, which is the cash flow statement. So we'll go into the cash flow statement, the operating, the investing, the financing cash flow, ultimately the net cash flow for the business. This is probably the most important line item that we look at. Probably for any bankers that are in attendance, it's probably also the most important line item that they look at, because really the company is the most important stakeholder in any succession and exit planning process. And without a healthy company, there is no success or no party, so to speak, for any of the other stakeholders that are involved. And so anytime we're looking at a succession planning strategy, whether it's a sibling buyout, like in this case for this client, gifting strategies, key employee buyouts, all of those, we want to make sure the company is generating the cash flow that it needs to fund all of its obligations first and foremost. So for example, making sure it can fund capital expenditures, debt repayments, be compliant with debt covenants, make ownership distributions, all of those things, because without that, then whatever strategy we're recommending just isn't going to work. And so one of the ways that we actually did that for this client, as Tim mentioned, Matt was very conservative, and he had this emotional feel that it was all on his shoulders. The bullseye, he made a comment actually that the bullseye was on his back. And so we showed him, the first question was, can we even afford to do this? It ended up being this company, they agreed to an $18 million valuation. They bought out 50% of the business for $9 million. So first time in the company's history, they're taking on that kind of debt. And so we showed him, here's the debt, here's the interest payments, principal, the debt covenants from a few different banks around the valley. The company could easily afford it. I mean, it was a $20 million business that's generating $5 million in income. It's very profitable. But Matt, because of his nature and that emotional component, was very concerned that, well, what happens if, my biggest customer, and they had some customer concentration issues, what if they changed the pricing on my contracts? What if they pull a contract? What if the economy changes? And so we actually showed him basically a sensitivity analysis and showed him worst case scenario. If they could lose up to 25%. Another scenario, it wasn't going to happen, but is that going to happen with Matt running the business? And Matt, it was almost a gut check, if you will, for Matt to say, if I'm running it, would I lose 25%? His answer was no. I feel confident in my abilities that I can take this business and not lose 25% of where we're at today. And so what it really did is gave him the clarity and ultimately the confidence to move forward with the transaction. I think without that knowledge, he probably would have backed away, because they could have taken this business to market and sold it for $18, $20 million and each got $4 or $5 million a piece and went their separate way. But I think that because of the why of transferring it to next generation, that's what our parents did. We want to do that for our kids. He really needed to see it in a worst case scenario so he could make that really sound planning decision for him. We'll also go through the balance sheet, different assets and liabilities. We can change things, inventory turns, payable periods, receivable periods, to see the impact on cash flow and then ultimately the impact on valuation. We'll go through a few different methods. I'm not going to go into the specifics, but we'll use a DCF method or a discounted cash flow. We can do cap rate if it's like a real estate holding company, earnings multiples, revenue multiples, book value if we want to, depending on the industry, like contractors or something like that, the value of their business is just a multiple of the balance sheet. What's important, though, is that we just want to be able to put a stake in the ground to show what's the value of the business look like today, and what does it look like over the next 3, 5, 10, 15 years, so we can really see where are we headed as an operating business. And then what we do is basically aggregate everything on the summary page. We found out that most of our clients aren't exactly spreadsheet geeks like some of us in the room, and they like pictures and like to see how things are really going to play out. And so I'll just go through a few of the main graphs for you guys. This one here just kind of sets them in reality. What does my personal net worth look like today? And then broken out into major asset categories. As you can see, about 70% or so of this client's net worth is tied up in that operating business, and we know at some point they're going to have to diversify out into other income-producing assets, whether it's alternative investments, cash, securities, real estate, whatever the situation may be. And actually, to be totally honest, they look better than some of the clients that we do have. Some of them, it's 99%. I mean, it's all in all the time for that growth, and so that's fine, but we got to make sure that we're aware of what are those unintended consequences of continually reinvesting back into that operating business. We'll also be able to look at an aggregate of all of their operating businesses. Tim talked a lot about the silo approach before, and I think that entrepreneurs experience that as well if they're members or have ownership interests in multiple businesses. They don't really look at things holistically, but they can dive into detail and say this business is succeeding, this one's costing me money, but they don't really step back and almost look at it from a private equity perspective of, what's my entire operating business portfolio look like? And so we can dive into each business if we want to and go into the specifics, or we can look at an aggregate of all of their operating businesses. What's the total EBITDA, enterprise value, equity value, and then the green bar represents their share. So what do I own of all of these different business ventures that I'm a part of? We'll also look at their personal free cash flow. So this looks at all of their cash inflows and then subtracts out all household and lifestyle expenses, income tax liabilities, and debt repayments. So when I talked earlier about the ripple effect of decisions that we make in the business and how does it show up for them personally, this is the graph that we really look at. If I grow my business from $40 million in sales to $50 million, what does that really mean for me? Because if I'm going to end up at the exact same spot, do I want to go through all of that headache, sometimes the drama, sometimes all of that hard work just to get to exactly where I'm at today? Or if I'm going through a sibling buyout like these clients, this was Matt's model, and so there was as part of the buyout, $6 million in debt was owed by the business, $3 million was owed personally. And so we showed him, here's the debt repayments that are on you personally that you're going to have to come up with regardless if the company generates the cash flow and makes its distributions. And so we really show that even from personally, it's going to work out for you from a cash flow perspective. We'll also then look at everything from a financial security, or what we call core capital. So that's basically the amount of net assets that are needed in order to sustain their retirement goal or their lifestyle goal. In the case for these clients, it was calculated as $25,000 a month of net after-tax spend. And then what we do is project that forward, increasing at inflation, and then present value all of those future tomorrows to see what's the amount of assets that are needed today in order to meet that financial security goal. That's the black line right here. You can see it's about $10 million or so. We'll then look at that from the net worth perspective. So the blue line represents their after-tax personal net worth. If they were to monetize everything, what would they have access to? That's great if our clients are interested in actually exiting their business and having a monetization event. But if you're looking at gifting the business, there is no big liquidity lump sum payment that's going to happen. And so we also need to look at everything from a liquid net worth perspective, and that's this dashed green line right here. So that basically represents their liquid net worth plus the present value of income-producing assets. In other words, if you own a piece of property, you have a rental agreement, you're generating cash flow, we'll present value that to see what's the value of that. Usually it's in a illiquid investment. What's important here, though, is to see at what point in time does this dashed green line cross over the black line, because that's the point where they've moved from I need more to I have enough. And effectively, you reached a point of financial freedom and really flexibility and options. At that point, you could gift the business, you could sell it, you could wind it down, you could do whatever you wanted to, continue to be owners, investors, because you know you have enough assets elsewhere to rely on in case the operating business fails. What it really shows is at what point can I be financially secure regardless of how this operating business operates in the future. We'll also look at everything from a spouse security perspective, so making sure that my spouse is taken care of if something were to happen to me. Basically, we'll look at the spouse security need. Usually that's somewhere between 60 to 80% of the joint need. There's going to be fixed costs for homes and kids and those types of things. And then we'll compare that to the blue line, which represents spousal net worth. And how we actually calculate that is we basically apply a percentage to each asset class of value that, in this case, Jane can rely on in the event of something happening to Matt. So, for example, 100% of cash and securities, because we can spend those assets and you can get a step up in basis. 60% of retirement plans, because there's that deferred tax obligation that has to be paid. 0% of real estate. In the case for this client, Matt didn't want to have Jane have to be forced to monetize their forever home just for her to be financially secure at some point in the future. And so a good example of that is actually if I take out the insurance policy that they have in force, we can easily see what is that deficit that needs to be covered. So for example, if we're looking at liquidity planning, we want to make sure that we're matching up the asset with this liability. So we know that they have a shortfall of $4 million today, $3 million in a few years, and over the next 7 or 8 years, that liability goes away. Well, in that case, then they don't need permanent coverage, they need term insurance, and we can match that up. And so that's just an example of how we're using the modeling to make some really sound planning decisions. Clients in this situation may be faced with an insurance person trying to sell them $5 million of permanent coverage. Well, we can say, well, you don't need that. Based on your modeling and all of our assumptions, that's just not necessary for you. We'll also look at everything from an estate liquidity perspective, make sure there's enough liquid assets to pay that estate tax liability, and then also from a legacy perspective, so just how much of my net worth is going to go to my heirs versus how much is going to go to the government in the form of estate taxes, and then if I had any charitable or philanthropic intentions, how much is going to go to charity. The nice thing as well about the way that we've designed the modeling and how we can use it to help our clients stress test these decisions is this is over the next 10 years, but we have the ability to look out 20 years, 30 years, or even 40 years if we want to. Obviously, making a projection 40 years in the future can be somewhat unrealistic at times. If I could do that, I probably wouldn't be in this room right now. But what's helpful is just the concept that hindsight's 20/20. So if we can put ourselves out there 10 years from now or 15 or 20 years and see back to today, we should be able to make some really sound planning decisions. Good example of that, this client, based on their baseline scenario, when they're 87 and 86 years old, maybe right around their life expectancy, they may be faced with a $21 million estate tax liability. I haven't met a client yet that wants to pay that kind of money to the government or wants their kids to have to pay that kind of money to the government. And so we can help them and say, well, how can we mitigate some of this growth where the liabilities today is almost $5 million and it's going to grow to 20? Should we do some estate planning work? Let's meet with your estate planning attorney and talk about different wealth transfer strategies. And then we can stress test it and see what does it look like if I gift part of my business or I do a sale to a defective trust or whatever the situation is on all of these other areas of focus. The other thing that I wanted to talk about as well is, most of our clients really like to see worst case scenarios I talked about, but they like to see other scenarios. I'm sure you've had meetings with clients where they're looking at things and they're asking, well, maybe I should just monetize my business, or maybe I should, go and do a phantom stock plan or an ESOP, or have you heard about this strategy that somebody in my, YPO group talked to me about, or whatever it is. And so we can show those on here so they can instantly see what's the ripple effect of those decisions. A good example of that is, when we were engaged with this client a few years ago, there was concern of, well, maybe we should just monetize the whole thing. We actually, since then, we've been working with them for the last 6 or 7 years now, and they're actually going through potentially another transaction where, originally we had 4 shareholders, 2 bought out the other 2. Now we're in a situation where we have 2 shareholders, and we're probably going to have 1 shareholder buy out the other one. And so we can show them just that kind of what if scenario where if they were to sell their operating business, say in 2019, we can instantly come back here and see what's the ripple effect of that decision. So instantly now my liquid net worth obviously jumps up. I've converted that illiquid operating business to liquid assets. But here's what I'm going to get net after tax from the sale of my business. Here's how it changes my spouse security need. So now I really don't need any sort of liquidity because I have tons of it now. How does it look at things from an estate liquidity perspective or from a net to heirs? All of those different areas of focus, because anytime you make a decision in the business, it's going to ripple through to several different areas of an entrepreneur's life. And so why we created this and the reason why we kind of have our process and this financial modeling tool is so we can show them how can we stress test those things. If it's an employee benefit plan, if it's just growth. Oftentimes we'll have situations where clients need their business to grow in order to meet their financial security objectives or whatever their goals are. And so what does that look like? How much is that going to cost on an annual basis? What's your return on investment? All of those different things really need to be stress tested and looked at in order for a succession or exit to really take place.
Thank you, Michael.
Sure.
So could you close that, turn on the video for the internet people? And we have 15 minutes, and we'd love to answer any questions that anybody might have about any scenario. I mean, we have, like I said, a body of work with well over 80 family groups, and none of them were the same. And so what we found is that each engagement we work in cannot be a templated process. It needs to be custom tailored to fit that client, and not because many businesses are that different from each other. It's because the human element and the dynamics that are present with the human beings associated with each scenario are different, right? So any questions? Doug. There's two Dougs right next to each other.
What are your return assumptions in your modeling? Because a lot of that has to determine what assets they invest in with those liquid assets. They're exchanging one economic engine for another.
Absolutely.
Right. So very conservative approach if we just look at the return on investment, but we'll work with professional wealth managers and load the portfolio, right? And then Monte Carlo that out so we get some exactness. But typically it's looking at a net return on things of about 4%.
Yeah, so I would say that, on average, we're probably going to be somewhere in the 4% range just to be conservative. But what we want to do is really factor in, the client's risk tolerance, right? I mean, if they're, a good example, this client, they're invested in primarily bonds. Shocker, right? But we want to make sure that we're not showing that, if you monetize your business and then
Remember,
we're going to grow
he's the most conservative person on the planet.
Right.
His client.
Well, and that's the thing is that we'll work with individuals like yourself to say what should the rates be, and the nice thing is that it's flexible, and we have some situations where some clients, rather large family groups, that have publicly traded companies. Outside of that, they're looking at 1 or 2% because they know my public company, the growth rates could be very large or could be very low or go very negative. So all of my other assets, I just want to know that it's going to be there when I need it. So
The other Doug.
So this was a real case. How close to reality were your projections after the transaction? Who was proving them that?
Well,
How close did it come out?
Well, we've since updated their personal financial statements and the business stuff, and so they buy the business for $9 million in the end of 2012. Part of the motivation on that was that, as you remember, going into 2013, there was going to be a different cap gains tax, and so they were real motivated to finish the transaction. So we actually closed 12/31 in 2012. So then we continue to financial model things out. So if they go to transaction today, they'll receive for 50% of the business, $24 million. They blew out the numbers. So he performed well. I mean, he did what he said he would do. So now the next trick is who's the next leaders, so on and so forth, and how do we continue to grow, which is awesome. Does that answer your question? Yeah. So even when we look at growth in the business, because we're nonlinear, we take a very conservative approach to that as well. But it's kind of based on where's the gap and what gap do we need to fill, and what does the operations look like to achieve that, to increase the odds of success. So if we look at things from the private equity perspective, and if there's some private equity people in the room, we're really educating our client on how to turn those knobs before they sell it, right? So why don't you untap the unrealized value of your own company before you go to market? And you don't do that overnight. So what's the runway? Then we got to be mindful of, if you can get a 7 multiple today, and we've spent 5 years doing this, and you can get a 4 because of the economic conditions at that time, what does it look like? So by being able to really live and breathe in the operating asset and then flow back to the personal, it anchors them in the what-if possibilities and the upside and the downside of all that risk associated with it, right? Because those are real questions. Right? So if you're in a down market, then maybe you're going to have to hold for 2 years. So maybe it's a 7-year run because the multiples are down. But we can contemplate all those things, and then it's really not putting our risk tolerance on things. It's letting them make a great decision based around their risk tolerance. Any other questions?
Tim, just an operational question. What's your secret sauce for getting the business owner to give you all that information?
Well, it's really the first phase of our process, right? So this is, if somebody tries to sell exit planning or succession planning, it can't be sold. I've been doing this for 12 years. If you sell it, you're going to have a bad outcome. Either they want to do it because they've wrapped their mind around it and they know they need to do it, and then you provide a process that creates momentum and maintains that momentum throughout a process where you create that checklist on a 30-day cycle. That's the secret sauce. If you try to sell it to somebody that doesn't see the value, move on, right? You know that from any practice. If you just take this one thing away today, it's what I started with, is every client wants to improve outcomes. No matter what you do, by knowing you, they want their outcomes to improve, right? They all have complexity if you're working in the right profile. And you want to play in this profile. They have complexity. They want help with that complexity. And they don't know everything. We work with a lot of type A individuals, hard chargers, right? We got to break down that barrier and go, so you know all of this. You've done all of this by yourself. You're a self-made individual that didn't have any help. We're not the right firm to work with. We want to bring you into a collaborative process that is real, and we're going to challenge you as an accountability partner to get stuff done. We're not here to be another yes person in your life, right? So they have uncertainty about, I've done this for 25 years. My runway short. Is what I'm thinking going to come true? And there's anxiety increases as that runway shortens, right? Because you can make outcomes way better if you have some runway associated with them. And then that collaboration piece, we have seen the power of collaboration on the behalf of our clients that we serve as trusted advisors change that dynamic. I mean, to be honest with you, sometimes when we ask clients, we'd like to interview your CPA, we like to interview your attorney, we like to interview your wealth management. I don't have them at the table all the time. Why don't we have them come to the table after? And this isn't a slam, it's a reality check. Are you on that same side of the table or not? And you want to be, because you can really serve your clients when you're on the same side of the table. And when we work collaboratively, it's a beautiful thing. It's life-changing for these clients. Love it. Changes the whole rhythm of the relationship, changes your position in the relationship if you don't have that position right now. So think of those three things. They're walking through your door regardless with that on their minds. They have that complexity, right? They have the uncertainty, and they're not collaborating with their advisor team at all, typically, 99% of the time. So if there's no more questions, I really want to thank everybody for spending the time with us today. If you have questions after the fact, call any one of us that you have a relationship with. Happy to brainstorm things, happy to go to deeper dive on a fact pattern that you might be dealing with right now. Whether we work together or not, use us as a sounding board. That's free, right? Have a great day. Thank you.
You're done too.